subscribe now and press the bell icon. Never miss an update.
So let's get started now. So now we'll focus on education credit. So we all know, in economics, whenever we have learned it, like in our school time or college time, we always know there are two categories of goods: merit goods and demerit. So government will always have a policy to encourage the consumption of merit goods, and demerit, like maybe alcohol or cigarette and all, they always put lot more taxes on it to discourage its consumption. So again, education is one of that the whole focus of government is to give as much education as possible, or to encourage that, so that there's some kind of incentive also and all. So this is very usual to see education credits, but that's given only for higher education, that means college education. And this is the fact that a lot of students in US, they just drop out from school. A lot of them, they don't go to college. Reason being, that's just the part of the culture and all. They have to be on their own, or they think they go and start working somewhere, they think, oh, they're making good amount of money, what's the use of studies and all, right? Or the parents, not all the parents will support and all. So it's very common to see. So again, the emphasis is that if you are sending your kid for college education, or if the kid himself or herself is funding the college education, then there's some kind of benefits that they can avail as far as it comes to the tax law. So those are education credits. You will not get those credits for sending your kid to a elementary school or middle school or high school. Those are anyways free. Those are anyways free, given by public schools. Most of the US all the public schools are anyways free, and most of the kids will go to public schools only in US, because the kind of quality and the education that they give is very high. That, it's not like that they are far below than private schools and all. They're almost at the comparable level at a lot of counties. Some places they might be obviously falling back. So these credits are given only for higher education or any vocational training. Okay. And American Opportunity Tax Credit is one of them. There are usually two kinds. There were actually three kinds. One is the tuition expenses deduction. But that is a deduction. That is not a credit. That is a benefit that they could get, but it was only valid until last year. Now what they've done is they're just focusing on two credits. One is called American Opportunity Tax Credit, which is called AOTC. We call it very commonly AOTC. And the other one is lifetime learning credit. So we need to, again, what is the difference between these two? There might be difference in the AGI requirements. The focus should be people, those who cannot afford, or those who are earning below certain amount, they should be getting that credit, not anybody who's making millions of dollars. They can easily send their kids to whatever college they want to, right? So why give extra benefit to them? So if the income is under certain level, yes, they are eligible for that. How much they are eligible for, the rules are different for both these kind of credits. So we'll go over that one by one. American Opportunity Tax Credit is, they can get a maximum credit of 2,500 per student for each of the first 4 years of post-secondary education. So there is a form called 1098T, that's a tuition statement. Usually the college will give that form. That form says that some kind of tuition fees has been paid to that college for this particular student. The name of the student will be mentioned there. College details will be there. Based on that form, we can go ahead and claim tax credits. Even if the form is not given, we can still go ahead and claim it. It's not going to get denied, but IRS may come back and ask, like, where are the details? Which college did they go to? How much did they incur? Where is the tuition statement and all? So the maximum credit is 2,500. It applies to first 4 years. And when we are working on our tax form, it will usually ask all these questions. Is this, which year it is, which year of higher education it is, first year, second year, third year, that's one of the questions. There will be more questions like is the student still continuing, or has the student dropped out of college, or has the student been rusticated out of college, all those things. The credit applies to tuition and tuition related fees and all. Okay, it's only these kind of expenses can be claimed. It cannot be claimed for room, boarding expense, health fees, transportation, and all, because those costs can differ from person to person. One can have a Mercedes to go around, one can go in public buses. We don't know. One can take a simple room sharing with other students, or if the person is really rich, they will go for something, maybe their own room and all. So that cost is not standard. It's very subjective. So IRS has strict instruction that only if you're paying whatever amount you're paying as tuition fees to the college, or if you're buying some books and other required course material, then it is allowed. Maybe the student is an engineering student and they'll say, oh no, I want to buy this psychology related books and all, and I'm really interested in this subject, that subject and all. Like, they may go and buy it on their own, but this is not a required course material. A laptop can be a required course material. A lot of things are like, I mean, it's impossible, it's virtually now these days impossible to do the studies without laptop. So yeah, that could be a required material. Okay, any education expenses, even if it's paid in 2023, but if it belongs to 2022, we can claim it in the first 3 months of 2023, if those expenses are paid out. The credit cannot be claimed if they're taking some other student the tuition program, or if the student is convicted of a felony and all. This means, again, this is one of the question that the software will ask, that has the student been convicted of any kind of charges, or any possession of controlled substance. That means it could be drugs or something else. If any of the illegal work, if the student is caught with some illegal activity, yeah, they will not get the credit. And the student has to be at least, like, there are certain number of minimum classes the students need to take. You cannot say we cannot just enroll for one course and go for, like, maybe 1 month during the year and say that, okay, I'm eligible for that. There has to be some requirement for that. The student If the student is not taking at least one half of the normal full-time workload for any academic period. Again, they're not being very strict that you have to strictly go to each and every class, take every subject and all, because US education system is very, very flexible. The student can enroll for one semester, they can drop out for another semester, they can again re-enroll and all, or they can take a break, they can take some more time to cover their courses or credits. Again, the reason is maybe the students is also doing some part-time work, maybe they have some other responsibilities and all. So it's very flexible that way. They have to keep into account, they have to consider the culture of the country before making these rules. And again, the credit will phase out if the income increases above certain level. And this is what the income that they have given for single taxpayer and joint returns. Up to 40% of the credit is refundable and all. So we'll go over some of the examples. We don't have to get into like how it is calculated and all. What we need to remember is, if there is education expense, especially college education, we can definitely see if the taxpayer is eligible for certain credits. There are two kind of credits: opportunity tax credit or lifetime learning credit. We need to run both the credits to see which one is giving the most benefit to the taxpayer. There are certain conditions for it, that those conditions we need to know in order to claim that. So if we know at least this much, we should be able to ask right kind of questions to the client, that okay, do you have a kid who is going for college education? Or we can always see last year's return and see, or maybe we can look into the dependent's age. There is a there is a form where you have all the dependents information. Maybe if you see that the kid has become 17 or 18-year old, 19-year old, it's very reasonable to think maybe the kid is going to the college. Even if the client is not giving, let's ask that. It's some of the things we need to, like, if we know these things, it will strike to us that, you know, maybe this can help the client, because they may not know all the rules. Some of the people, they are so they're so ignorant of that, they will not even know. They'll say, oh yeah, my kid is going to college, yeah, that's fine. They don't even know that the certain education credits exist. So it's our responsibility to ask at least and tell them if they qualify for something more. How do we calculate? Again, this is given. What is that? The qualified expenses we need to take into account and all. What is the adjusted gross income? If it is falling under that, they may get full tax credit or they may get a reduced tax credit and all. Yeah, that's fine. We'll go over some of the examples. We'll go over this, then it will be very clear. There could be, as we saw it, a part of that could be refundable. How it will come up as refundable, there are again certain rules for that. We'll go over that. Okay, and all these formulas and all, they're already embedded in our software. We don't need to mug this up all, but we need to know that there is a AGI limit, there is a limit on tax credit. Doesn't matter whatever they're paying, there's only maximum so and so they can get. A part of that can be refundable if certain more conditions are satisfied, or if it's not refundable, it is just going to decrease your tax liability, but we don't get any refund back. Okay, so let's start going to through that.
Um, Jack and Jill Smith, married taxpayers who file a joint return, have combined modified AGI of $172,000. They paid
Okay.
$3,000 in tuition expenses for their dependent daughter, who is in her second year of college, and $8,000 in tuition expenses for their dependent son, who is in graduate school. The tuition expenses the Smiths paid for their son do not qualify for AOTC because he is not in his first 4 years of post secondary education. The 3,000 of tuition expenses paid for their daughter's education qualifies for the credit. The tentative credit allowed is $2250, that is 2,200% plus 1,000 to 25%. However, the Smith's AGI is within the phase out range and their credit must be reduced accordingly. The Smith's allowable credit is calculated as follows.
Right. So let's look into that. So what they're saying is that combined income is 172,000, and what this and here for merit filing jointly, um, they are saying that if the income is between 160 and $180,000, then some phase out limit needs to be applied. If the income is below $160,000, you will get the entire tax credit. Okay, that must be somewhere here. The phase out will apply if the income is between 160 and 180 on a joint return. So we know the income is above $160,000, they'll definitely not get full tax credit, but it is still below 180,000, right? It is still below 180,000, so they are eligible for some credit. Now they are paying for their two kids, but we can take only college education expenses. Okay, so they are taking $3,000 as tuition expense for their daughter, and again the rules are given. How do we calculate the the tax credit? We saw it somewhere, right? Yeah, 100% of the first 2,000 of qualified expenses and 25% of the next 2,000. This is how they calculate it. So if they are spending $3,000, we will take 100% of first 2,000 and 25% of next 1,000, because at the most what they are spending is only 3,000. This is how they have calculated here, that okay, the 3,000, this is like it is coming to 2,250. If their income was below $160,000, they would have got the entire tax credit. But now they are within the phase out range. Phase out meaning of phase out, you will see this word a lot used in IRS taxes and all, that it is phasing out. Phasing out meaning it is going down, it is diminishing. There's a maximum limit. Now we are the benefits are phasing out, they're decreasing. So the credit must be reduced accordingly. And how they need to be reduced, this is the formula that they've already given us here, that whatever they are, we have to take 180,000 less MAGI and all. So you'll take 180,000 because that is the highest limit in the phase out range. Phase out is 160 to 180. We'll take 180,000. We'll take their income, which is 172, divided by 20,000. How 20,000 is coming? We are not putting it. We are not getting it anywhere from this thing. It is um, part of the formula which is given. We don't have to. We don't really have to like pull our hair to see where this 20,000 is coming from. They're clearly saying if it's joint return, you take 20,000. As a denominator. So whatever it is, and then it comes to divide by 20,000, take a ratio of that. So what the maximum credit that they can get is only $900. And all these calculations are put up on that form. Tanya, do you remember what is the form number for education credits?
8863.
Give the form number.
Of
Education credit. Any credit, whether it's lifetime or American opportunity, there's a proper form that needs to be included in 1040.
Is it 8863?
Huh?
8863?
Yes, it is 8863. Yes, I think it's 8863 only. Okay, so any questions on AOTC? This is important. This is very practical. We need to understand this properly.
So I just wanted to know what will be the refundable portion. I mean, 8863 will be non-refundable portion, and then it comes in line 28 with American Opportunity Credit.
Mhm.
I was so like, how do we bifurcate between those two?
Most of the time, it will be non-refundable, but we have to see what is the federal income tax liability is greater than the results of step 3. What is the step 3? How to calculate this thing? Okay, if the federal income tax liability is greater than, then it's a non-refundable because it is just decreasing it. But if their income tax liability is so less that the credit is more than that, then they will get some refundable, which is again only 40% of the total credit which is coming up. It needs to be compared to what is the federal tax liability. Okay, in some cases the federal tax liability may be really low. They may be having very less income, so the tax would be very low.
Okay.
This is not very commonly seen, but yeah, people those who have really low income and all, we may see the refundable portion of AOTC. It is not like additional child tax credit where everybody will get a refund regardless of their income. What we need to remember and how this is done and all, if you put those numbers in the software, it will immediately tell you what is refundable, what is non-refundable, because all these comparisons are happening in the background. Okay. Now let's look into lifetime learning credit. So again, lifetime learning credit, there's a limit on it. It could be only maximum $2,000. Then this is based on the $10,000. Like you just take 20% of the total qualified education expense, and that is the max that one can claim. There is a phase out limit. This is what they have given. Same pretty much for married filing jointly and single as well, 160 to 180,000, and that's what we saw here as well for AOTC. Okay, and the credit again, it cannot be used for room, board, activity fees, and all. It has to be only for tuition expenses. The eligible expenses are only tuition and fees expenses. Because the reason I'm saying it again is people may say, well, I have to, the college is in Michigan, we live in California, we have to go all the way there, stayed in hotel and did this and that and all. We must have incurred like $5,000 of extra expenses. And that's all part of education, because of the college we need to go there, so my expense list is very huge and all. We need to tell this is strictly limited only for tuition fees, nothing else. So let's go over this example as well. Ayush.
Um, Verne is a single taxpayer with a modified AGI of $52,000. Verne has two dependent daughters in graduate school. He pays $6,000 in tuition expenses for each of his daughters, for a total of $12,000. The first $10,000 of these expenses qualifies for the lifetime learning credit. Thus, Verne may claim a credit of $2,000 bracket $10,000 into 20%. There is a no phase out of the lifetime learning credit of Verne because the credit phase out for single taxpayer commences when modified AGI is $80,000 and ends at $90,000.
Yeah, so okay, so the again the AGI limit is far below than what they've set for single taxpayer. So he's definitely qualifying, and he's paying 6,000 in tuition expenses for each of his daughter. So $12,000, and he can claim full tax credit. There's no phase out for Barney because he's not. His income is far below than the limit that they're giving. One difference, if you guys notice here, they are taking um, the dependent daughters are going to graduate school and they're taking those expenses. But in American opportunity tax credit, they clearly said that only college education expenses are taken. Son's education expenses were not taken into account, who's going to graduate school. The tuition expense do not qualify because he's not in his first 4 years of post-secondary education. So again, the way like we need to understand what we call as graduate may not be the same thing as what it is there in US. So they call it as the graduate, postgraduate, and all. And graduate could be like graduating from high school as well. So what we need to focus on, is it college? It cannot be high school. It has to be a college, or it has to be a vocational course. They can go for some vocational course as well, like maybe learning plumbing job, learning carpentry and all. That is all allowed. But there is no such restriction on lifetime learning credit. So again, that also tells us that we may have to like change our approach and see what can be claimed for the client. Is this clear? This is the statement that I was talking about, 1098T. This is for tuition statement. 1098 is given. If we have it, it's best to take the numbers from there because IRS also gets a copy of 1098. It's very easy for them to verify what we are claiming. If we don't have it, we can still go ahead and take it, but there's always a risk that they'll come up and say that, give us proof that you have paid this fees and all. Okay, let's go to the next one. So 8.4, maybe Varunji, can you read?
Wesley and Brandy Cat, who file a joint tax return, have an adjusted gross income AGI of $158,000 for 2022. Their daughter Honey began her first year of graduate
We
school
should
on
say
July
son, huh?
21.
Right, honey?
Their daughter oblique son Honey
Right.
began her first year of graduate school on July 21, 2021. Wesley and Brandy incurred tuition expenses of $12,000 in 2022. A lifetime learning credit is limited to 20% of the first $10,000 of tuition paid. The lifetime learning credit is available in years. The American Opportunity Tax Credit is not claimed. The CAT's credit for 2022 will be $2,000, that is $10,000 into 20%. There is no phase out of the lifetime learning credit for the CATs because the credit phase out for married taxpayers filing jointly commences when modified AGI is $160,000 and ends at $180,000.
Yes. So again, income level is quite low. The moment we see income of lesser than like 160,000, we should immediately think that yes, most of the benefits will be available. And they have paid $12,000, so they can take full 20% of the first 10,000, and that's the maximum that they can get in lifetime learning credit. Remember, this is a credit, so whatever their tax liability is, it will get reduced by the credit amount. Okay, there is no phase out, but we cannot claim both the credits together. So only one kind of credit can be claimed. American Opportunity, there are certain restrictions there. It has to be only for 4 years of college education and all. But lifetime learning credit doesn't have that kind of restriction. And that's why the amount is also lower than what can be claimed in American Opportunity Tax Credit. Lifetime learning credit will also not be a refundable credit, but AOTC may give that benefit of also being a refundable credit. Okay, I hope that's clear now. Okay. Okay, one more thing I think I missed saying, that this credit cannot be given if the status is married filing separately. And that's again something we have seen with a lot of other credits. Did they talk it somewhere here? Yeah. Neither credit is allowed by married taxpayer who files separately. They must file the joint return. If they are filing separately for whatever reasons, they will not get this credit. This is another reason why we keep telling all our clients the best strategy is to go and file married filing jointly and all, because that's where they get the maximum benefits. Okay. So let's go to another important one, which is called child tax credit. Again, this is something very typical to only US law. I don't know if there are any, like at least in India, we don't see any credits given for number of children in the family and all those things. But there is something like that in US. So there are 4 credits. We'll just go over that quickly. There are 4 credits available for children and or dependents. That could be child and dependent care credit. So dependent can be parents as well. It's not like if only child can be dependent. It can be any other relative also, which falls in the definition of what they've given as relative, and that person can be dependent. There are certain rules how the person can be claimed as a dependent. Like if you're providing more than 50% of the expenses for that person and all those things, and the person doesn't have their own income, if certain things are satisfied, yes, that person can be claimed as a dependent. Usually, parents and children are claimed as dependent in the returns that we see, but yes, uncle aunts can also be considered as dependent, or siblings, or even cousins in certain cases. And the child independent tax credit is reported on Form 2441. So that's again an important form. CTC, as we call it, child tax credit. It's a very commonly used term here, CTC. CTC is non-refundable. But additional child tax credit, which is ACTC, is refundable. So when we see why there is a refund coming, typically always have this question we always have this assumption in mind that, okay, go and check on 1040. Maybe this is ACTC coming up, which is giving the refunds. Because child tax credit will not result into any refunds. Okay, so now there are certain conditions who can claim these credits and all. Again, they're saying here clearly it is non-refundable. Can I mark this thing? I need to, or maybe I can just do it. The taxpayer is eligible only if item B and C are satisfied. That means employment. One of the condition is that both the parents should be working. And this is where when we say that we have a dependent in the house, the dependent needs to be sent to dependent care facility, or we need to have some arrangement made in the house so that the dependent can be taken care of. So either we hire a nanny or babysitter or somebody, or we send them to daycare centers. Because if both the parents are working, then there is no way they can leave the child alone. So that becomes a required expense for them. Or if one is earning but the other one is a full-time student, or if both of them are full-time student, then also they are eligible for that. But if one of them is earning, another one is a homemaker, then they will not get this, because there's one person, one of the parents should be at home to take care of the dependent. In that case, they don't get it. So there has to be employment and all, and we will see this somewhere else. They will be putting it that the person can be a full-time student also. Household cost, how do we say that a person is dependent? The taxpayer has to provide more than half of the cost of maintaining household. Then this person becomes a dependent. Then, like, for the person whom the cost has been provided, that person becomes a dependent. Under age 13, or if it's physically or mentally incapacitated, then there is no age limit. The person at the age of 40 can also be basically physically or mentally challenged, and they may be considered as a dependent. The person must have lived with the taxpayer for more than the half of the year. So there are these conditions. We have gone through them in like our first or second chapters, if you guys remember. Like, we are not going to spend too much time on that, because that is not what is important. What is important is how can we claim the child tax credit? If yes, how much it is? What is the limit on that and all? A special rule for children of divorced or separated parents: even if the taxpayer cannot claim his or her child as a dependent, the child is treated as a taxpayer's qualifying person if so and so thing can be happened. That means the child, it could be possible the child is not a dependent. Maybe the child is living with the mom, but dad can still claim the child on the tax returns. If they're providing the support, or or if the mom is not claiming, but both of them cannot claim and all. Um, Okay, then any employment related expenses. Yes, obviously, what are the qualified related expenses? Any daycare expenses, babysitting, housekeeping, and all, nursery, the kids may be sent to nursery and all. So, those all expenses can be claimed. Now, one important thing we need to remember is, in order to claim 2441 uh, expenses, which is like dependent care expenses, we always have to have the details of the service provider. If we do not have their tax ID number or their name and address, we will not be able to claim. So if the taxpayers are hiring someone to come to their house and take care of the kids or the other dependents, they need to get their social security number, their address, everything, because their number is being reported to IRS. We need to report that these are the people, or this is the agency, or this is the company, or this is the school that we have hired, in order to get dependent care services. Um, yeah, obviously dependent. I mean, like, if you're making a payment to the relative, yes, if the relative is really not not related in the sense that if the relative is not a dependent, yeah, we can make the expense. We can make the payments to them, and you can take the credit for that. But again, that this rule should not be used for own advantage. That means the parent cannot come and say, well, I have a 15-year-old daughter and I have a 5-year-old son, so I'm paying my daughter who's 15-year-old to take care of the son who's 5-year-old. So I need a deduction on that. I need a break on that. That's not possible, because both of them are your dependents. Yes, if the daughter was like maybe like above 18 and she's not a dependent anymore, she's living outside, but then daughter says, well, I can come and take care of my little brother for 3-4 hours a day or whatever, but pay me for this. Then it's fine. So the relative can be, but the law cannot be misused. So we need to see what is reasonable, what is not. Some of the things are very commonsensical for us to understand. And if we don't know, we can always go and look for the instructions, what can be claimed or not. Okay, so I think we have seen things. Yeah, we'll go over the example. There are certain limitations that the limitation is $3,000 for one individual and 6,000 for two or more individuals. Like the dependent care expenses cannot, the benefit cannot go above that. One can pay up to 20,000, 30,000, 40,000 during the year. That's not the point. They can pay anything they want to, but what is the benefit that they will get? It is capped to these limits. The credit is equal to 35% of the expenses paid during the year, but it gets reduced by 1% for each 2,000 if the income is increasing above certain level. And this is what we call phase out. As the income keeps increasing, the credit will keep reducing. In this case, they are saying that if the income is increasing by each $2,000 income increases, the credit will get reduced by 1%. Otherwise, straight away you can take 35% of that amount as a credit, but there is a limit on that. It cannot go beyond this $3,000 or $6,000. We have to have taxpayers identification number in order to claim the credit. We saw that in one of the returns that we went ahead and in fact we even filed the return. We accidentally, for the taxpayer identification number, instead of putting the service provider number, accidentally we just put one of the dependent social security number. The software did not give any error. It went for filing. It got rejected from IRS, saying that you cannot use the same SSN because this belongs to dependent. How can dependent be a service provider? And then we realized, okay, we made a mistake. We should have accidentally we put the dependent's social security number instead of putting the service provider's tax identification number. But it was not giving any error. So there's a lot of ways it may happen that when we are working on the tax return, it will not give error. That doesn't mean that we are doing whatever we are doing is 100% right. We still should go over each and every form, scan through it thoroughly, see are we making any mistakes. Because software has its own limitation. If you're filling up that field, it's fine. It will just take it and say, okay, this field has to be filled up. This is a mandatory requirement. You filled it up, fine, it will take it. It may give an error saying that you're putting the same social security of a dependent and all, but in our case it did not give that error, and we went ahead for filing and it got rejected, and that becomes a kind of embarrassing situation. Then after that we are going to the client and saying, well, we made a mistake, we don't have the correct number and all, can you provide it again? Right, so we need to remember all these things. We'll go over this example in a minute. Let's just cover this up. So what is the child tax? Here we saw about dependent care expenses. This is about form 2441. Dependent can be anybody. It can be child. It can be someone else also in the family. There are 4 credits available. We saw the first one. Now we will look into what is CTC, what is ACTC, and then credit for other dependents. Because the child has to be under age 17. If the child is above 17, you cannot claim that credit. Even though for all different purposes, all these other things have been satisfied, that the child is still a dependent, child does not have his own income, it lived with the taxpayer for more than half and all those things, it's fine. But this is also one of the important conditions. Okay, and the maximum credit is $2,000. It is not refundable. We have already seen that. Additional child tax credit, it can come up as a refund, but the refund is capped at $1,500 per child. It cannot go beyond that, but and the additional child tax credit will come for certain individuals who get less than the full amount of CTC. So if full amount of CTC is $2,000, but you end up getting only $1,000 or $500 because you're above certain limits and all, and you're not being eligible for that, what IRS is saying that okay, we'll give you any other additional child tax credits. Okay, and the credit for other dependent is $500 and all. So this is again, this can be used for the child also, but it is for any other person as well who does not have SSN, but they need to have something called tax identification number. And this is again very commonly seen that the family is moving to US, the same the spouse, the working spouse who got H1B visa has a social security, but other dependents in the family, they just get ITIN number, income tax identification number. That is not a social security number. There is a difference between those two numbers. It's not like in India we have only one number, right? What is that?
PAN number.
PAN. There's only one PAN, whether it's like minor or major or whatever, or there's only one number that person goes with. But in US, there could be two different numbers. SSN is something, the person who is a permanent, a kind of resident there, who is earning and who is paying towards social security. That's why it's called social security number. Any other person who may just have an income in their name, but they're not eligible for social security benefits and all, they'll get ITIN. Okay. So for ITIN numbers, the credit gets reduced. They will not get full $2,000. So again, if you're looking into, if you're working on the tax return, you're saying, well, this person has two kids. Maximum they can get is like $2,000 per kid. So $4,000 of child tax credit should definitely come up. Both the kids are below 17 years of age. The income is also not very high. Why is it not coming? We need to go and check, what are we putting? Do they have a social security number? Or they may have ITIN number. And the way to check is usually ITIN number will start with digit 9. If you see any number starting with 9, that could be ITIN number. Again, it's very important, if we see an ITIN number, we should ask the client that, hey, do you still have ITIN number, or did you got it changed to SSN? Because a lot of times, maybe first 1 or 2 years they get ITIN, then their visa, they get different visa, they get EAD, maybe they get green card or something, and then the ITIN has to be updated by SSN. Maybe client has never done it, so we need to tell them that, okay, you have a green card, why are you going with ITIN? It's not giving you benefit. Go with SSN. Sorry. So all that needs to be taken care of. So there are certain more conditions here. The SSN has to be there. The person has to be US resident, alien, and all. It's not possible that the person is working in US and say that I have my family and kids staying in India. They are actually my real dependents. So I have 2 kids. I want to claim them. The child has to be in US. The child has to have some tax ID number. Otherwise, it's not possible. Right? It's quite possible that the maybe only husband or maybe only wife has moved to US for maybe say 1 year project, 2 year project, and all. They cannot claim. If they are US citizens, then the rule is completely different. If they are US citizen, they can live anywhere in the world and they will still get all the benefits because they're citizens. They don't have to live actually in United States in order to claim benefits. Okay, so let's go over these examples.
Kimberly is the head of household taxpayer with twin 2-year-old daughters. Kimberly has an AGI of $80K and is eligible for a 20% credit on the first 6,000 of dependent care expenses. Kimberly spent $7K on childcare, allowing her to claim a 1200 dependent care credit, that is 6,000 into 20%.
Correct. So we saw 20% is the limit here, and the maximum that they can claim is on that expense. I don't know where it was, but a taxpayer with AGI of 40 above 43,000 will have a credit of 20%. And what is Kimberly's AGI? It's $80,000. So this will automatically get reduced. She will not get full benefit and all, and it will get reduced to 20%, whatever she's spending, and she's able to get 1,200 dependent care credit. Even though she's spending 7,000, she might be spending 15,000, 20,000, but she can get only 20% credit on first 6,000. Why 6,000? Because she's having two daughters or two kids, and they can claim 3,000 per kid. Okay. Um, Tanya, can you read CTC age test 8.6?
The taxpayer's son turned 17 on December 30th, 2022. He is a citizen of the United States and the taxpayer claimed him as a dependent on the taxpayer's return. He is not a qualifying child for the CTC because he was not under age 17 at the end of 2022.
So, what is the requirement here? Explain, Tanya.
What is his age on December 31st, 2022? If he's 17, then he's not qualified, but if he's 16, he's qualified.
Right. So, he's already turned 17. This is why we always need to ask date of birth, especially for the new clients. We cannot do the tax returns without date of birth for their kids as well. Again, there is a big difference between how US works and India works. We need the entire family information. Give your wife's information, give your husband's information. We need all your kids' information. We need your parents if they're staying with you or if you're their dependent and all. We need all of their information as well. Okay, because all these credits and all they can claim. Next, Tanya, keep reading 8.7.
Your 10-year-old nephew lives in Mexico and qualifies as your dependent. Because he's not a US citizen, US national, or a US resident alien, he is not a qualifying child for the CTC. So you will not get any credits for somebody living abroad.
Correct, correct. Because citizenship test, or meaning residence test, also we can not strictly citizenship, but it needs to be resident. The person is not living there, they will not get it. Now, again, if the AGI is above $400,000, there's no benefit. It's completely phased out, and it's reduced by $50 for each 1,000 whatever AGI exceeds the threshold. So this limit, do not pay much attention to this. I mean, next maybe in couple years they make it 420,000, 430,000. We are not concerned about that. What we need to know is like it's really high, they will not get any tax credits. So the moment when you put in all the information, still the credits not come up, go and first of all check AGI. What is AGI? Yeah, AGI is like $700,000. It's too high. Like at the most, like until $400,000, all kind of credits get phased out. So that makes sense. Okay, so we'll just close it here. 1 minute. I have something else also. Yeah, we'll quickly go over this chart. It will, and this will understand whether we can take whether the taxpayer qualifies for the credit or not. Was the care for one or more qualifying person? If the care is for a qualifying person, yes, you can claim the credit. The person is not qualified, no, you cannot claim any credit. The taxpayer cannot claim any child and dependent care. Okay. Does the taxpayer have earned income? There has to be earned income. That means there has to be a W-2 income, employment income, and all in order to claim. That's why we're saying both the parents should be working. Yes, one of the condition is that they need to be salaried people. For Schedule C also, yeah, both of them may be full-time self-employed and all, but it doesn't give that credit. 1 minute. That the taxpayer pay the expenses to allow the taxpayer to work or look for the work. Yes, there has to be some expenses, because if the taxpayer is not claiming, not paying any expenses, what will they claim credit for? They'll say, okay, my aunt lives right next door, she'll just come and take care of my kids every day, I'm not paying her anything, then how can I even claim those expenses? Were the taxpayer payments made to someone who could not be claimed as a dependent? That person, the same example, you cannot pay to your elder daughter to take care of the younger daughter or younger son and all, because both of them are dependent. Were the taxpayer payments made to the taxpayer spouse? you know we cannot say that, okay, I'm the spouse, I'm the mom or I'm dad, but I'm staying at home, I need that payment to take care of the dependents and all. Were the taxpayer payments made, sorry, this is done. Were the taxpayer payments made to taxpayer's child who was under age of 19 and all? Yes. We cannot claim. No is that, like, we have to see now all these conditions are satisfied, then we need to see if the taxpayer is single or filing a joint return. If the taxpayer is not filing a joint return, if the taxpayer is filing separately, they don't get any benefit. If it's single, then again all those conditions are same. We need to get all the care provider name, address information, and we have to make sure that the expenses are actually being paid out. Okay, at least $3,000 of benefits and all. If all these conditions are satisfied, then the taxpayer may be able to claim child and dependent tax credit. Why still may be able to claim? Because we also have to see what is the income for the taxpayer. But at least all conditions are satisfied, we'll be able to put all information on form 2441. Whether it gives the credit or not, we still have other income requirements and all. That's it. So we covered child tax credits, ACTC, CTC, dependent care credit. Okay, I think we are good. We have covered all of it, and it's time, so we'll stop it here.